Can you all see the screen, the PowerPoint presentation?
Yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
Okay, good, good. Yesterday, we went through some requisites for a successful financial center, political, economical, legal, regulatory, and communication factors, peace maintained by the police and the forces, rule of law by legal system, and the judiciary, good communication system by the communication companies, labor, skilled labor. These are good material for a good understanding. Urban infrastructure, especially transport system. Then there shouldn't be any discrimination for foreigners or domestic participants. There shouldn't be any religious or ethnic bias. Then the low taxation, regulatory light-handedness, currency used for international transactions, head officers of multinational companies, cosmopolitan culture, widespread command of English language. Right. So those are the requisites for a successful financial sector, for a city to develop itself as a domestic financial center, to a regional financial center, to a global financial center. So in Colombo, we are a very small domestic financial center. We are looking forward to strengthen ourselves, become a bigger domestic financial center like Mumbai or Kuala Lumpur, and then to become a regional financial center like Singapore, Hong Kong, and then thereafter to become a global financial center like New York, London, Tokyo. So what are the key features, or what are the key components of a financial system? Basically, we discuss institutions, regulations, instruments, and markets. Institution participation should be there, local institution, regional institution, international and multinational organizations. And regulations should be there to protect the depositors, to protect the investors. Then there should be financial instruments to manage the portfolios from the minute or smallest retail outlet or individual to small corporates, up to medium size, and then to large MNCs, for them to use financial instruments. And there should be sufficient liquidity, and then there should be unbiased price discovery, and then there should be markets with exchange efficiency and the liquidity to support the volumes of transactions in this financial system. So the financial institution we were discussing, financial system consisting of institutions and regulations that act on the international level, as opposed to those that act on the national or regional level. The main players are the global institutions such as IMF, Bank for International Settlements or BIS, national agencies, government departments, example central banks, finance ministries, and private institutions acting on the global scale like banks and hedge funds. Regulations to protect the savers or depositors, and then to protect the investors. I need to enlighten you. Protecting the savers or depositors, whose job is it? Can I have the response from the audience, please? Who should be protecting the saver? Any idea? And who should be protecting the investor? Are there institutions designed to protect the saver depositor? Are there institutions designed to protect the investors in our market?
The regulatory authority generates the savers, right, sir?
Yes, okay. Can we be more specific, please? Who is there to protect the saver or the depositor? Whose job is it?
Ultimately, I believe the central bank ensures that the depositors are protected, right, through regulation.
Okay, then investors will be protected by whom? Investor? Idea? Sorry? Can you speak up?
So investors are not too sure, sir.
Not too sure.
Yeah.
I heard a female voice from the background. Who should be protecting the investor? Whose job is it to protect the investors? Sorry? Right. The first answer is correct.
The government?
Government? No, there should be, government cannot do the protecting of the investor. The government will only enact the laws, parliament acts, and the regulations. Government will delegate that to a statutory body or a bank or somebody to protect, ensure the protection. So let me come out. Protection of the depositors and savers is the job of the Central Bank of Sri Lanka under the Monetary Law Act under the Monetary Law Act of 1949. The central bank was created to protect the depositors and the savers, and they do it through the Department of Bank Supervision and Department of Non-Bank Supervision. Bank supervision covers the licensed commercial banks and licensed specialized banks, and non-bank supervision covers the finance companies and the primary dealers. Right, primary dealers supervision was carried out by the Public Debt Department until recently, but now that function has been handed over to non-bank supervision department. So again, the protection of depositors and savers is ensured by the Central Bank of Sri Lanka through Director Bank Supervision Department and Director Non-Bank Supervision Department. Okay, in the same way, there should be a protection for investors. Who is the statutory body entrusted with the job of protecting the investor? It is the Securities and Exchange Commission, SEC. Securities and Exchange Commission. They mainly operate the Colombo Stock Exchange and Colombo CAC to carry out little bit of regulatory measures. But as you all know, Colombo Stock Exchange is a composite of all the stockbrokers. The stockbrokers are members of CSE. But SEC is the regulatory arm to protect the investors. And not only the stockbrokers and the investors through the stockbrokers, plus the investors in the unit trust and other funds are also protected by the SEC. So is there a difference between the function of protecting the depositor saver and protecting the investor? What is the aim or expectation of depositor or saver? And what is the expectation or aim of an investor? Is there a difference? The depositor or saver will want to entrust the excess savings with them to someone trustworthy for them to keep the excess savings, excess over the expenditure, savings, excess savings over expenditure. They want to keep, safe keep with banks and finance companies for future use. In other words, depositors and savers, they postpone the present day consumption to future. Now you all at the young ages, you should be having savings accounts or fixed deposits and try to save for your future, for your higher education, for your marriage, for your to educate your children, and finally to look forward to a retirement with a comfortable life, either with a pension or so. That is postponing your present day income, excess savings over expenses. After meeting all the expenses, the savings you entrust to a bank or a finance company or any other mechanism that they promote to attract your excess savings, and you entrust your savings with those to those banks to safekeep. So coming on to the SEC and the investors, what do the investors expect? Is it only the savings to safekeep? Investor meaning they need a high return. They would want the whatever the excess funds that they invest with a investment, within inverted commas, investment carries or investor expects for his investments a high return. That investment, expectation of investment, comes with a risk. The return on investment can be plus or minus. When it's plus, it's a profit. When it's minus, it's a loss. So what are we speaking here now? Whether savers or depositors deposit with banks or finance companies, their capital is 100% safeguarded. The rate of interest that they receive could vary, but capital plus interest, capital is 100% protection. But when it comes to investors, the investment, even the capital can erode when the return is minus or when they incur a loss. So the SEC is supposed to be with some skill of carrying out the protection function for the investor, because the institutions that accept the investment from the investors could produce positive results or negative results, in which case the investors shouldn't be unfairly treated by those institutions who manage those investments, the stock exchange or the unit trust or any other fund who declare dividends or profits, are expecting a high return, maybe over a period of time, long time. As you all know, Colombo Stock Exchange investments generally enhance over longer period of time. Those investments could beat the annual average interest rate or annual average yield of whatever indicated by the interest rate curve or yield curve of a country. So these are the differences. Depositor saver is protected by the central bank. Investors are protected by the SEC. And there is a third regulator, Insurance Board of Sri Lanka, who have been entrusted to protect the insurance policy holders or policy insurance buyers. Insurance Board of Sri Lanka function is to protect the insurance policy holders. So these three regulators are functioning in our market, authorized by or appointed by the government through their various legislations or acts of parliament. All right. Any question on that, please? Is it clear?
Yes, sir.
Good. So regulations. We were speaking of licensing. Now the licensed commercial banks and licensed specialized banks are licensed by the Monetary Board of Sri Lanka through the Central Bank of Sri Lanka. A local bank. Now we had the good experience of Cargill's Bank in the year 2012. We applied for the license and they took long years. And in 2014, we were given the license and then we operated on it. And that's a really good experience to create a banking institution from the scratch. That's a local bank. When it comes to a foreign bank, a branch of foreign bank being established here, again, they have to go through the same process, application for license to the central bank through the director bank supervision and obtaining the license from the Monetary Board of Sri Lanka. Then finance companies, they have to apply for license through the non-bank supervision department of Central Bank of Sri Lanka. And again, the license is granted by the Monetary Board of Sri Lanka. When it comes to money brokers, until 2018, money brokers were given a letter of no objection by the central bank. Those days, it was the chief accountant of central bank later on, I think it is the Director Bank Supervision or some authority, or Director Domestic Operation Department, DOD, issued that letter. But since 2018, money brokers too are given a license by the Director DOD, Domestic Operation Department, to operate in our market. What do you think the essential requisites to become a bank, a commercial bank, or a specialized bank, or a finance company, or a money broker? What should you demonstrate? What should you have? Can few of us get together and then apply to the central bank to give us a banking license, or a finance company license, or a money broking firm? Can few of us get together and do it whenever we want? What should be there? Any thoughts from anyone? Basically, to start with, there should be skill level. The promoters or the initiators should have the necessary skills of creating a bank or a finance company or a money broking company. Now again, I take the example of Cargill's Bank. Cargill's Bank was started by the Cargill's group of companies, Cargill Ceylon PLC, and then a few, they have 32 companies in their portfolio, but none was in the finance category or banking category. So they wanted to start up a bank. So what did they do? They hired specialized banking experts, specialized people who could start up a bank. Actually, there was 5 of us who initially were recruited by them, starting with Mr. Harris Premaratna, who was at Commercial Bank, later became MD of Sampak Bank, was the first MD of Cargill's Bank. And there was a gentleman specialized in IT who became the DGM IT. And there was a gentleman specialized in operation aspects. And I had the opportunity to join in as the expertise of risk and compliance. And then also to some extent, I had to handle the treasury operations. Likewise, there were 5 of us, including a legal expert who was to be the legal secretary of the bank. So we were able to create a bank. Likewise, even if you want to start up a money broking company, you have to demonstrate first of all, the skills. Secondly, the capital required. You should be able to raise the capital required. Now, how much do you think to start up a banking institution initial capital requirement? It's something like 2 billion. Then to start up a specialized bank, you may not need that much of capital, little less. But to start up a finance company, you need at least 500 million, or I think they raised to 1 billion, I think. To start up a money broking firm, again, you need a specified sum of capital. Basically, such money is required to create the infrastructure, the resources. To create a money broking firm, what are the infrastructure required? Basically, your telecommunication connections to all the banks and primary dealers, and setting up of voice recording systems, and creating online reporting systems through central bank websites. They have created FinNet, LankaFin, and some sites for the banks, non-banks, finance companies, and money brokers and primary dealers to submit their daily, weekly, monthly, quarterly, biannually, and then annual reports that they do. Why do the central bank, the bank supervision or non-bank supervision, or in the case of SEC, would require returns, information of activities on a day-to-day basis from the participants? And what are those information that they require? Now, relating to money brokers and your environment, the foreign exchange buying and selling, daily exposure, overbought or oversold situation, you simply call net open position, or NOP, net open position, in each currency, and then each currency converted into US dollar, and then in US dollar form, and also in rupees, Sri Lankan rupees. The net open position must be reported to the central bank on a daily basis. Then there is various other risk reports that are required to be submitted. Most of them now are online through LankaFin or FinNet, or there are a few other sites that they have created. For your information and knowledge, a large bank in the caliber of Bank of Ceylon, People's Bank, Commercial Bank, HNB, Sampath, Ceylon, would submit roughly about 225 or 220 such reports to the central bank and other regulators. There are other regulators as well, about 220. Medium-sized bank might submit about 175. A small bank would submit some little over 100 or 125 or 130 reports. I'm talking of daily, weekly, quarterly, monthly, and every 6 months, and then annual reports. There's for most of them, there are the formats designed by the central bank, and then those your computer systems that you install in your organization should be able to fill those forms automatically without manual intervention, or with very less manual intervention. You cannot be preparing the returns to the central bank item by item, report by report on a manual form. They don't expect that, and it will be not possible like that. So the next item that require for the license in a bank or a finance company or a broking company is the computer system or the core banking system. That core banking system should be able to process the transactions, various types of transactions, various types of products that are being transacted with the customers, and customer information. We generally call it KYC, or know your customer, and CDD, or customer due diligence. To populate those forms or reports, you need to store the customer information, customer's name, address, occupation, income, relationships, family backgrounds, and whether they own a house, whether they are in mortgage, whether they own a car, whether they have the other properties, what are the other sources of income. And all those information in the form of KYC, know your customer, or CDD, customer due diligence, should be stored in the computer system, so that when a transaction is concluded physically with the customer, when the computer system is fed with the basic data, the report will pick up the necessary information of a customer with the, say, the address or the occupation or the level of income, everything, and the amount of transaction, the buying, selling, lending, borrowing. And finally, the report is completed. In an organization, in a bank particularly, the report will be perused by at least 3 levels: the operator, the executive or the supervisor, finally the head of department or the manager. In case of it is head office, it could be the CFO, or it could be the CRO, Chief Risk Officer, or Chief Operating Officer. Or finally, there are some important reports which has to be approved by the CEO as well, or MD as well. So with these passwords, the online reports leaves the computer system of the bank or the finance company or the money broking company, and then is queued up or is received by the central bank or the regulators' computers through communication lines. So it is such efficient and such complicated operation that happens and is required by the regulator. All this is to protect the depositor and the saver, and to protect the investor. Okay. Any question on this? All right. Then I indicated the Basel I, Basel II, Basel III. Basel is the nickname for Bank for International Settlement, or BIS. Bank for International Settlements. Bank for International Settlement is located in Switzerland, in a city called Basel. So that's why the Basel name has come to use. So before explaining what Basel or BIS is, you all may have heard about IMF and World Bank. What does they do? What does IMF do and what does World Bank do? Can anyone respond? Whatever the financial activity taking place in our economy has a bearing and then has to comply with also the global concepts and global accepted norms. And those global institutions, they are called multinational companies, multinational or supranational institutions. Soon after World War II, there was a necessity to create institutions to look after the member states, sovereign states, for their the destroyed cities or the economies or countries to rebuild. So they created a Bank for Reconstruction and Development, Bank for Reconstruction and Development, now known as World Bank. World Bank is, the long name is the Bank for Reconstruction and Development. The function of that World Bank is to lend money to member states or member countries, sovereign countries, for various projects of reconstructions and development to improve the infrastructure. To become a member of World Bank, there is an annual subscription or membership fee. But the large countries like USA or Germany or UK, Japan, China, they contribute bigger sums, huge sums. But small countries like Sri Lanka would contribute only a small membership fee. But they are recipients of various funding projects from World Bank or Bank for Reconstruction and Development. So what does IMF stand for? International Monetary Fund. Around the same time, with the World Bank, IMF was created to support the member states for their fiscal difficulties or the funding, the government's, to improve the government's ability to meet the shortfall of fiscal or trade balances, balance of payments. So these twin institutions, World Bank looks after the reconstruction and development, IMF looks after the balance of payment difficulties in each country. So both receives membership fees from every member state, and the large countries pay them a large sums of money. Okay. So IMF and World Bank carry out these development activities in those lines. You might remember Sri Lanka also received a lot of IMF facilities whenever we had the balance of payment or trade balance differences to renew or to repay our foreign loans and sort of things. The structural loans was sent to us, given to Sri Lanka to be able to honor the foreign commitments or to supplement the balance of payment deficits. Right, now we can discuss the Bank for International Settlement. Bank for International Settlement is more or less the world's central bank in looking after the risk and compliance point of view. Or when banks operate, they do run risks. They are required to comply with regulations. So locally, the central bank, we discuss the Bank Supervision Department, Non-Bank Supervision Department looks after the banks and finance companies and money brokers. But on a world's point of view, it is the Bank for International Settlement that was created by the world, rather G7 countries those days, now is operated by G20 countries. Therefore, they have 20 directors as well, one from each G20 country, and located at the Basel city of Switzerland. Bank for International Settlement is supposed to be the world's central bank to monitor compliance of each banking institution and financial institution in the world through the respective central bank. So this BIS issues various directives to the central banks to be implemented in the financial institution in their respective countries. So what does Basel I say? Basel I directive came in early 1980s that when banks and financial institutions grant loans to the general public of a country, what are the loans for a bank? They are assets, right? What are the liabilities? The deposits from customers. Deposits from customers are liabilities, and assets are the loans granted out of the deposits raised. So those assets, the quality of assets to be monitored by the Bank for International Settlement and the central banks, a directive came. The name of the directive is Basel I. This indicates that the risk-weighted assets or the risk-weighted loans of a balance sheet of a bank should be the risk-weighted. Now, let me explain like this. In a bank, there are various types of loans granted to customers, right? The most riskiest type of loan is the temporary overdraft. When the accounts are overdrawn temporary measures without any security taken by the bank, without taking any mortgage or any other security, or without taking a guarantor, it is high risk for the bank because the customer who obtained the temporary overdraft from a bank can vanish without paying the bank the overdraft that they took. So the overdraft were risk weighted at about 150% risk, not even 1-to-1, about 1.5 times. If a bank grants 1 million temporary overdraft, it is risk weighted to 1.5 million. Then when the banks grant housing loans with a mortgage taken, the property mortgage taken, the house or the property mortgage taken, it is basically, there is some collateral. So the risk weight is about 75%. 1 million loan given on housing loan through a mortgage, risk weight is 750,000. And there is various categories of these assets are risk weighted. And those risk weightings are aggregated, and the total aggregated risk weights from the total aggregated risk weights, there should be minimum 8% capital maintained by the bank. What is capital? Capital is the shareholders' money. These banks, they have shareholders, and the shareholders' contribution to the bank's operation or shareholders' funds. You all might have done some accounts, and then you all should know what is capital and then what is the purpose of the capital: to start up operations, to support the working capital, and to run the business. The shareholders' contribution funding is the shareholders' funds. Number of shares held by each person, each shareholder, is the total fund contributed to the operation of the bank or company or primarily a company or whatever it is. So this, out of this total risk-weighted loans or assets, 8% minimum 8% should be in shareholder funds. Shareholder funds. The purpose is, in case of difficulty, the shareholder funds will have to be bailed out, used to repay the liabilities. Right? So the shareholders will lose their total funds invested in case of a liquidation. So the world standard indicated by the Bank for International Settlement was 8% capital should be maintained, minimum 8% capital should be maintained out of the risk-weighted assets of these financial institutions. So the Central Bank of Sri Lanka took a step forward and indicated that the Sri Lankan financial institutions should maintain not 8% but 10% capital of the risk-weighted assets. So Sri Lankan banks are maintaining more than 10% of risk-weighted assets as capital or shareholders' funds. So what is the use of this? How is it practiced? There should be a computation of the total assets of the bank balance sheet, and there should be a computation of risk weights and total up the risk-weighted assets, and there should be a computation of 8% of the risk-weighted assets, and the minimum shareholders' funds capital should be more than 8% in the world standards, but more than 10% in the Sri Lankan standards. So this saved Sri Lankan banks from various world episodes like East Asian currency turmoil in 1997 and 98, then subprime mortgage crisis in 2007 and 8. Most of the banks in the US, thousands of banks in the US and various other countries was closed down when those crises occurred. But Sri Lankan banks were safeguarded, saved, because the central bank's prudent decision to implement 10% of the risk-weighted assets as minimum capital. How does it work? Now, when the Sri Lankan Central Bank sends opens a letter of credit or LC to import something from a bank in Japan, because LC is normally communicated from a bank in local Sri Lanka to a bank in, shall we say, to import machinery from Germany. Import is separate customer, but the bank is opening the letter of credit and then transmit the LC to the seller's bank or exporter's bank in Germany. So the exporter's bank looks at this bank in Sri Lanka and then looks at the risk-weighted asset capital maintained. If it is more than 8% in the world standard, they're happy. In Sri Lankan standard, it's minimum 10%, so they are very much happy. So the bank is accepted. So the international trade takes place very fluently. Because in the case of importer, the customer defaults for payment for the import of machinery, it is the bank who opened the letter of credit must be paying the bank of the seller or exporter for the machinery shipped. Liability is on the bank. So the bank's reputation or the capability to pay is assessed through these risk-weighted assets and the capital maintained 8% or 10% by this particular bank. Understood? So this is very important. So the percentage of capital maintained out of risk-weighted assets is going a long way to showcase that we are strong enough to pay the commitment to you all in case the business transaction goes south, goes into default. So there is a comfort and the international trade takes place and foreign exchange is being transacted because of this comfort factor between the banks and understanding between the banks mainly. All right. So then we have to come to Basel II. There's another directive called Basel II. So Basel I was considering only the credit risk of the bank's ability through the capital of 8% or 10% maintain of the total of risk-weighted assets, loans. So it's supposed to be the credit risk. Basel II, when it came to Basel II, basically 1997, 1988 East Asian currency turmoil. After that, the Bank for International Settlement thought of issuing the second directive of Basel II to measure the risk-weighted assets for the credit risk as done in the Basel I, market risk, and operation risk on three spheres. Now, Basel I risk weighting was computed only on the credit risk basis, on the risk-weighted assets. So in addition, how does the Basel II operate for market risk and operation risk? It's very simple. I would explain to you in a nutshell. Apart from the risk-weighted assets for risky loans, capital maintain 8% or 10%. Market risk, when a bank runs a portfolio of investments, like treasury bills investments or treasury bond investments, or any other share investments, or investment in gold, or any other assets, or any investment in company shares, maybe banks do invest in company shares, right? And they are mark to market. You know what is mark to market? The purchase price is compared with the current market price, and if the current market price is higher than the purchase price, there's a profit. As opposed to when the current market price is lower than the purchase price, there's a loss. So it's called mark to market. You have to take that mark to market evaluated profit or mark to market evaluated loss as well into the computation of risk-weighted assets, and capital must be maintained for 8% or 10% out of the market risk as well. Then operation risk. The banks and financial institutions run various operation aspects in it. Basically, day-to-day operations, maintaining a computer system, maintaining staff resources, skilled staff resources, or maintaining disaster recovery sites when some natural disaster, fire, flood, or something occurs, bomb blast goes off. So good example is that, very simple example is that power failures. The computer systems and the operations of a financial institution is affected when the power failure occurs, isn't it? So to overcome the power failures, what do the banks and financial institutions normally do? They install a generator, standby generator. So there should be a record maintained for at least last 3 years, previous 3 years, the instances where the power failure occurred and how long was the duration and what was the business impact How many customers were not able to withdraw money from ATM? How many customers was in the queue on the counter and they were not be able to served by the bank because of power failure, and the financial impact out of that. So there should be a computation of financial impact for the last 3 years of each and every instance of power failure, and then totaling up those losses as operational loss of power failures. There's a complicated calculation. I don't want to bombard with you all the calculations. But again, for that risk as well, you should keep 8% or 10% capital. So in total, credit risk, market risk, and operation risk, totaling up, and capital should be maintained at 8% in world standard and 10% in the global Sri Lankan standards. So that is Basel II. Then when the 2007 and 2008 subprime crisis occurred in the world, a lot of financial institutions happened to close down, and economies, a lot of central banks had to support the financial institutions to come back to operations, like Lehman Brothers, and then few others had to be supported by the taxpayers' money, by the government. So in the Basel III directive, Bank for International Settlement issued a direction, other than the Basel II evaluation criteria, take into consideration the liquidity maintenance. Banks and financial institutions should be maintaining liquidity in a ratio called liquid cover ratio, LCR, from the year 2016. That came to came into effect. Show that is dictated by the Bank for International Settlement for all the financial institutions in the world, and monitored and implemented by the local central bank. LCR, or liquidity cover ratio, is a short-term measure for liquidity. And there's a long-term measure called net stable fund ratio, NSFR. Net stable fund ratio, long-term measure. Net stable fund ratio. So the liquidity maintenance by the respective financial institution was made mandatory up to those ratios indicated or dictated by the Bank for International Settlement through the respective central banks. So these are the main regulations that emanate from the world bodies and implemented through the local regulators in economy. IFRS is International Financial Reporting Standards, basically implemented through the Institute of Chartered Accountants. That's again a global standard, International Financial Reporting Standards. In Sri Lanka, it is called SLFRS, Sri Lanka Financial Reporting Standards. So in the maintaining of account, there is some reporting standards to be maintained. So those who have studied accounts might know better than me, but you better know that these are the key regulations that are prevalent when you operate a bank, like licensed commercial bank, licensed specialized bank, finance company, or a money broking company, or any other financial institution in economy. These are key regulations that should be maintained. Other than that, these three Parliament acts, namely Convention on Suppression of Financing of Terrorism, Terrorist Financing Act number 25, 2005, Prevention of Money Laundering Act number 5 of 2006. There are two amendments subsequently. Then Financial Transfer Reporting Act number 6 of 2006. These three Parliament Acts are called superlative acts, meaning when there is some issue discussed in this Parliament Acts, and if the same thing is discussed in a different act, what is indicated in this act supersedes the indication in the other Parliament Act. Example, Financial Transfer Reporting Act number 6 of 2006 indicates something like this, that all the financial institutions should record the KYC information, know your customer information of each and every customer and report to the Financial Intelligence Unit of the Central Bank of Sri Lanka of any suspicion of money laundering or terrorist financing, any suspicion, through a STR or Suspicious Transaction Report, STR, Suspicious Transaction Report, confidentially, without knowing the customer, without informing the customer. But in the Banking Act number 30 of 1988, there's a clause that the banker should protect the secrecy of the customer. Banks and finance companies should not divulge the information of the customer information or customer balances or customer transactions to anyone other than the court of law. That is the indication of the Banking Act. But the FTRA in 2006 stipulates that if the banking institution or the finance company is in suspects that the customer transaction, customer's money deposited is some proceeds of money laundering, is the proceeds to finance terrorism. In such cases, the bank or the finance company should send a STR through an online reporting system called LankaFin to the FIU that this transaction and the reason for suspicion. And that fact should not be informed to the customer, should be confidential. So FTRA prevails over Banking Act. All right. Any question up to this? No? Regulations, there are a few other world regulations. Financial Action Task Force, FATF, is a world body with headquarters in London. And the previous three Parliament Acts are directives of the FATF, recommendations. There are recommendations by the FATF to be implemented in each country through the respective central bank. So these three Parliament Acts are the recommendations of the FATF. The Basel Committee on Bank Supervision, again, the committee established by the Bank for International Settlement, the BIS, that we discussed earlier, provides detailed recommendation on customer due diligence, sets core principles. Yeah, then the United Nations, as you all know, the UN is the world body, world epic body, issues list suspected names, blacklisted names whose assets must be frozen, sanction lists which announced are by the Office of the Foreign Asset Control, United Nations and European Union. United Nations through the Security Council identifies or lists names of suspicious characters or blacklist countries, and then companies, banks, institutions, individuals, and then circulates among the member countries to be careful of these suspected names and then to prevent any transaction with them. Then those are called sanction lists. Each and every financial institution operating must be perusing these sanction lists and taking precautions against accepting deposits or granting loans or doing any transaction with those suspected or blacklisted characters around the world. And for that, there are various softwares, computer softwares, to pop up when you key in a transaction to a core banking system. If that specialized software is installed, it will identify the name of suspected names or the blacklisted names and then give a warning to the operator or the executive or the banker that you are transacting with a suspected name, you are transacting with a blacklisted name. And if such things happen, there should be a STR or suspicious transfer report issued, sent by the financial institution to the FIU for further investigation. And this OFAC, Office of Foreign Asset Control, is the FIU of the USA. Our FIU equivalent of the USA is Office of Foreign Asset Control. In the UN, United Nations, and the European Union, EU, they all publish the separate list of suspicious sanctioned names or blacklisted names. These three needs little explanation. US Patriot Act was issued by the USA soon after the World Trade Center and Pentagon attack by terrorists by crashing 4 planes into those buildings. US Patriot Act require the US authorities, the federal government, federal law enforcement agencies, federal police, and the FIU or OFAC to gather information on transactions channeled through the US currency or US banks. Whenever they want, the authorities want information of a transaction, any financial institution maintaining a nostro account in the US bank should appoint a legal firm in New York to represent them to supply information to the US authorities. And that is that agreement, or the US legal firms, head of legal firm and head of the financial institution locally in Sri Lanka, they must sign an agreement which is called US Patriot Act certification. In other words, you are employing a legal company in New York to represent yourself, paying a fee to supply information of suspected transactions to the US authorities. That is required by each and every financial institution around the world. Then Foreign Corrupt Practices Act 1977, again, like our penal code in Sri Lanka, there are some measures to be implemented to practice as a finance company or a bank in any other country in the world. Then Foreign Account Tax Compliance Act is a very peculiar act. Those tax evaders in the USA, US citizens who evade tax and then shift their business to other countries because of high taxation in the USA, US had required all the financial institutions in the world to identify the clients, whether they are US citizens or US green card holders or a person with a US permanent address or US business connection, and whether they are liable for US taxpayer payment. And any financial institution anywhere in the world should find out the tax status of such US connected people and ensure that they are paid their tax. So that is called Foreign Account Tax Compliance Act, or FATCA. So these are the regulations coming out of the international arena to be complied by the financial institutions anywhere in the world, particularly in Sri Lanka. All these are in operation and they should be complying to such things. Then based on the various Parliament Acts, the central bank, namely the Director Bank Supervision and Director Non-Bank Supervision Department particularly, and Director Domestic Operation Department, Director International Operation Department or IOD, or Director Foreign Exchange Department, those days it was, position was called Controller of Foreign Exchange, Controller Exchange, but now the position is called Director Foreign Exchange. They issue regulations or directives, the corporate governance directions, customer charter direction, related party transactions, maximum amount of accommodation, classification of loans and advances, integrated risk management framework. Such directives should be analyzed and complied by the financial institutions. So running a banking institution or a finance company or a money broking company is not a small matter. Comply to various type of regulations. So instruments. In a financial center, there should be basic banking products and instruments, savings account, fixed deposits, and various other types of banking products and instruments. As well as there should be investment instruments. There should be derivative products and instruments to manage the risks. You know what the derivative instruments are. We will be discussing in depth in one of the future days. And there should be hybrid instruments, hybrid instruments, derivatives, investments, and banking products carrying features of all types called hybrid instruments. Financial market. Financial market is a mechanism that allows people to easily buy and sell financial securities, commodities, and other fungible items of value at low transaction costs and at prices that reflect the efficient market hypothesis, or EMH. I'll explain what is EMH, or efficient market hypothesis. In a financial market, we'll take the example of the stock market. When you take a particular share, like John Keel's holding, we'll take, there are sensitive information affecting the price of the John Keel share price that are coming from John Keel's company. For example, they are developing a housing and apartment building complex in the Slave Island. That will bring revenue to the John Keel's holdings, and their cash flows and income will be enhanced. So that will contribute to the increase in share price, isn't it? Oils now, one of the recent incidents, the Colombo port, the East Terminal Colombo port, or the West Terminal Colombo port, construction will be given to the Indian company plus Sri Lankan companies. One of them are John Keel's holdings. So what is the outcome? The revenue that is generated out of the construction of the West Terminal in the Colombo port, the cash flows, the income streams of John Keel is going to increase, and the share price is going to increase. So likewise, sensitive information affecting the prices of the share price of the company shares. When they are the share price information, when they are information available to every investor, when the share information of the share price or the information of the company is available to every corner, everybody equally, is called strong form efficiency. Very efficient in information seeping through from the company, from the stockbrokers to all the investors, whether they are small investors or large investors who would buy and sell John Keel shares. And there are some other information which can flow into only a limited crowd. That is called semi-strong form of information. Strong form information, asymmetry, and then semi-strong form asymmetry, information asymmetry is the not all the investors would receive such information. Then weak form of information asymmetry. There can be inside information which are not available to the rest of the investors. Weak form. In the composition of the Sri Lankan markets, what do you think? We belong, in Sri Lankan markets, belong to the weak form of information systems, or semi-strong form information systems, or strong form of information systems? What do you think? Weak or semi-strong or strong? I think we may not be on the strong form information asymmetry. All the inside information may not come into the knowledge of all the investors on a very quick time limits. We are either semi-strong or weak. So what is the outcome? The share price fluctuations might occur without knowing the reason by the investors. Either small investors or rural investors or whoever it is, share prices could fluctuate. So efficient market hypothesis is that it's a hypothesis or just imagination. Look for the meaning of dictionary meaning of word hypothesis. It's just an opinion of someone. So efficient market hypothesis is that always the market is supposed to be, information is seeping through to every nook and corner, every investor. The sensitive information is flowing through to everyone. That is the expectation. That is called efficient market hypothesis. Expectation, efficient market expectation. So if you take that as a standard, it's called efficient market hypothesis. So asset prices or the share prices reflect all available information when the efficient market hypothesis or the expected information is flowing through to all the investors in the market. Isn't it true? When the information of a share or any particular asset or maybe a treasury bill or treasury bond, price sensitivity will be adjusted very quickly when the sensitive information is going through to everyone very quickly. Another example is that when there is a central bank decision to reduce the interest rates, treasury bill prices, prices or treasury bond prices will go up, shoot up. So if that information doesn't flow through to all the investors, it can be weak form of efficiency. But this EMH or efficient market hypothesis assumes that the interest rate reduction information will flow through to each and every investor in treasury bill or treasury bond very quickly. So asset prices will reflect all information available at the double quick time. A direct implication is that it is impossible to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information. Right? Now, when all the information is available to everyone, the market prices will react only to new information that is coming up, because the prices that are prevailing is reflective of all the information that is already come out of the organization, company, or the central bank. This is called EMH, or efficient market hypothesis. This hypothesis is practiced or discussed at financial economics higher studies. So I thought of introducing it to you all, for you all to at least know that there's something like this. So the efficient market hypothesis argument against the EMH points out that investors value stock differently. Investor 1 may value John Keall share at a different level, and investor 2 might value the John Keall share at a different level. That's an argument brought in against the efficient market hypothesis. It is impossible to determine what a stock should be worth under an efficient market. Proponents of the EMH conclude investors may profit from investing in a low-cost passive portfolio. Proponents are those who advocate, those who support efficient market hypothesis, that thinking, conclude investors may profit from investing in a low-cost passive portfolio with new information coming up. Okay. So I think the final slide for today. Financial markets facilitate. To raise capital, the capital markets are there. Capital markets will facilitate raising of capital. Transferring of risk, derivatives market is there. Derivatives, financial instruments are designed to manage risk or transfer risk from the risk-averse person to risk-tolerant person. Risk avoider to risk taker. Then international trade market is there to take advantage of the currency markets. So these three, please memorize. Through capital markets, one could raise capital. Through derivatives market, one could manage risk. Through currency markets, one could manage international trade. So they are used to match those who want capital, deficit units, to those who have a surplus unit, those who have capital or surplus units. So this is very important in the financial markets, capital market, derivative markets, and currency markets are to facilitate capital, risk, and international trade respectively. All right. So we have reached the time allocated. So I would again appeal before conclusion today to research and then write a good assignment to demonstrate your commitment, ability, skill, and focus for your studies And when you groom yourself to dedicate yourself, not only to obtain the certificate in money broking, but to pursue your other higher studies as well, to prosper in your life. All right? Okay, boys and girls, then let's meet on the 20th of April at 4:30 p.m. through the same channel. Okay, any question at the last moment before winding up? Anyone want to express anything? Anybody want to comment, ask a question? No?
All good, sir.
Yes, Sajitra? You said something? Yes? Yeah, please speak up.
All good, sir.
All good. Ah, good. Okay. Looking forward to assignment writing?
Sorry, sir?
Are you looking forward to assignment writing?
Yes, sir, yes.
Very good. How about Asri? Are you also, do you have any question?
No, sir, no questions.
No questions. That means
Yes.
you understood everything what I said.
Yes, sir, understood.
We'll see when the exam comes.
Okay, sir. You see. Thank you, sir.
Thank you. Lakshan, any comment?
No, sir. No.
No questions. Okay. Niluk, how are you? Any questions?
No questions, sir. Perfectly understood today.
Very good. Vindhya, we could not speak to you at the beginning. How is your...
So she had to actually go to the hospital for a family emergency, sir.
Right.
So she was logged in, but she was not in office.
All right, okay. Then Tilini, what is your response on the assignment? What's the progress?
Nothing done on yesterday, sir.
Uh-huh.
I hope to continue showing on this weekend.
Yeah. I want to see your progress, right?
Yeah.
I want to see your progress. Okay. Good luck.
Thank you.
Mahil, how are you? Any question?
No questions, sir.
No questions.
Yeah.
Praveen, how are you?
Great, sir. No question from my end as well.
So, I am a superhuman. I have been able to convince you all with all the concepts that I have spoken so far. Trevor, any question, Trevor?
No, sir. All good, sir.
Oh, good.
Speak is understood.
Very good. Sandharwan, how are you, Sandharwan?
No any questions, sir.
Okay. How about Isuru?
All good, sir. No questions.
Right. Okay, then I wish you all good luck until 20th.
Thank you, sir.
Enjoy with your families as well.
Thank you, sir.
Thank you, sir.
We'll meet up on the 20th.
Thank you, sir. Okay.
Thank you. Good night, sir. Thank you.
Good night.
Good night, sir. Good night, sir.
Bye.
Good night.
Good night, sir.
Good night, Isru.